Market review again. Yes, I'm so excited. We always gotta be vigilant of the bear to see if the bear is coming, see if he's done hibernating. But obviously, as you'll see in this video, no, he has not come back yet. The bull is still in play, but we're gonna use this as an excuse to go over the markets anyway. And once again, Alex from MacroOps is gonna help us with his latest brief on market conditions. So he said his overall read of the US market remains the same, which is one, that we're in a broader technical uptrend, and two, that long-term positioning and sentiment is still off sides, which supports higher stock prices. Now, this is the same thing that we've been saying in every video every week or every time we've done this. Things in the market, the conditions, they don't change that fast, but it's good to check in, once in a while or once a week. But if you're looking for those videos where we describe more of what we just said in those two sentences, then click this link up above. Now, with that said, the market still needs to work off some of its short-term overbought conditions. And this chart right here shows the percent of stocks trading above their 50-day moving average. And Alex says that based off this chart, he thinks that process is taking place where we're getting through the short-term overboughtness. Is overboughtness a word? I don't know. But an analog you can use to see what's currently happening is what happened in 2016. So you can see we got this double bottom, which is similar to what we saw here. And now Alex is thinking that the market is going to chop sideways for a while, like right here, which is what we might be starting to do in the current market. So Alex says a couple of weeks of choppy volatility will help keep sentiment in check, and indicators like our 10-day moving average of the total put to call ratio elevated and above the red line, which is right here, meaning that fear is present. So we talk about this in every video, but sentiment, right? That's what we're analyzing. We want fear to be in the market, because if there's fear, then that means there's more people that are not in the market that can convert to being in the market, pushing more money in and driving stocks higher. The time when you got to be worried about a bull market ending is when everyone is really happy, euphoric, when they're super bullish. When they're bearish, well, the bull market still has room to run. So one of the ways you could analyze fear in the market is with the put call ratio, which is what this indicator down here is showing. So puts, as you may know, is the right to sell a stock. So if you're buying a put, you're betting on the stocks going lower. A call, on the other hand, is the right to buy a stock. So if you're buying a call, then you think the stock is going to go higher. So if you look at a put to call ratio, if this number is higher, then that means more people are buying puts, which means they're bearish on the market. So the way Alex uses this is, as long as this line is above this red line, then it's a good signal for the market because fear is present. You can see what happened before when it dropped below this red line. You got the spike up as people got real excited, and then the big drop. Same thing happened back here. But anyway, yeah, a few weeks of choppy volatility should keep fear in the market, which is good. And some sideways action will also help reset shorter term indicators of sentiment, which have become elevated recently. So sentiment traders said that on Monday, not one of our indicators were showing a pessimistic extreme, but there was a jump in indicators showing an optimistic one, to a total of 40% of all indicators. This is the third time since the beginning of 2018 that we have seen this condition. So you can see when optimism gets high, the market starts to roll over a little bit, which you saw there, here, and you might be seeing here again. According to Sentiment Trader, the S&P's returns going forward were decent, though the market tended to experience some weakness in the near term after this indicator was triggered. So long term, the bull market would still be intact, but over the short term is where you'd see some volatility in it rolling over. And that's pretty much in line with what Alex was saying. And then we see that the credit market is also diverging from stocks, which suggests that we should see some equity weakness ahead. Now, the credit market, which is this black line, it usually leads stocks because it's an indicator of risk mentality. So if credit keeps climbing higher, stocks do too, because it's risk on. People want to put their money into the market. So if you start seeing this go sideways, you got to watch out, because this will likely turn around too. It's a leading indicator. And it's the same case with the cyclical versus defensive stocks, which we've talked about before as well, where if you want the market going higher, you want cyclicals doing better than defensives. And you can see right now that trend is turning while the market is heading up. This gives you a little clue that things might get a little shaky, just a little bit shaky. But even if there is a pullback, it probably won't be a deep one, because there are so many fund managers and investors just off sides right now, which we explained in the previous videos. So Alex says it's likely to be more like 2016, where we had choppy and volatile sideways action. And he wrote, of course, things could change if the Fed surprises. This was written before that meeting was through. And it turns out that the Fed did surprise, but they surprised in a positive way. They pivoted both on interest rates and their asset portfolio. So basically, it was good news for the market, and you saw that nice little pop Thursday. So previously Jerome Powell, who's the Fed chairman, he was known as a hawk because back in December he was signaling 2 more rate increases in this year. And they were saying that they were going to keep letting their balance sheet run off. So if you increase interest rates in the economy, that makes money tougher to get because you got to pay more for that money, right? So if money is tougher to get, then there's less money moving into stocks and stuff because people don't have as much of it. And just assets in general and just the economy. That's why when the Fed hikes interest rates, normally the stock markets don't react positively. They like the easy money environment where the interest rates are low. And it's the same thing with the Fed's balance sheet. Before, the Feds were buyers, so they're pumping a lot of money into the markets. Now though, they've been sellers, which is too much supply. Obviously the market is going to go lower. Once again, liquidity contraction, less easy money. Many investors worried about rising risks to the US growth from abroad and from political uncertainty had hoped the Fed would suggest it might not raise rates at all in 2019. And others didn't want the portfolio runoff because the tightening policy was just too much. But by Wednesday, Powell basically gave everyone what they wanted. So when it came to rates, the Fed said that the rate hikes were indefinitely on hold. And that's because of heightened risks to the global economy and because strong US growth and falling unemployment last year didn't deliver an expected upturn in inflation. The Fed didn't get what they were expecting with those numbers. And as far as their balance sheet unloading goes, they said they would slow the pace of treasury bond redemptions in May and end the runoff by October. And I don't know if I explained this properly, but the idea that the balance sheet runoff hurts the economy is because it drains liquidity from the financial system. So when the Fed is selling assets, it's basically forcing the banks to buy them, which pulls money out of the economy. There are some other effects from the increased supply though as well. So the Fed surprised and we got this big pop in. Right now we're looking like we're turning lower again. Now one of the systems that I use, we actually got out of the indices right here on the 8th, which looks like turned out to be that short-term bottom because markets just rocketed right after that. But I was following the system, and I mean the system gives out great signals, but it's not going to give out perfect signals every time. Plus this is all real short-term what we're looking at. So the market could easily turn. I mean, look at today, but this is 12:45 on Friday, so who knows what's going to happen next. Now yeah, I felt some FOMO when the thing took off without me as soon as I exited, but I did not let that FOMO get in my way. I didn't chase, I didn't try to jump back in, and that's because I had this guide to help me out. It has all the tips and tricks you need to avoid feeling that feeling that's going to make you screw up your system or strategy. So if you want to get that guide, just go here to this page. It'll be linked up above and below in the comments and description. Enter your email and I will send it to you. It's free and it's useful. Definitely do that. And what also helps, like the one system got out right, but my other system, the NASDAQ All-Stars, it stayed in. I had full exposure to various NASDAQ stocks, which did really well that day. And if you want to learn more about that NASDAQ All-Star system, it's a momentum trading system that I use. You can watch this video I made about it. I'll link to it right above. But yes, all in all, we should see some short-term volatility and sideways action in the markets. Maybe. I mean, who knows what's exactly going to happen in the short term, right? But long term, the bull is still intact. No bear yet. And if you want to keep tracking the markets with us, make sure you subscribe to this channel and hit that notification bell so you get an email notification when the next video comes out. We publish 7 days a week, all about markets and business. Subscribe, come hang out with us, learn something, laugh a little. In this video's case, laughed very little, sorry. But subscribe, and I will see you in the next video. Stay fallible out there. Bye.